Hello class, we are going to go through the chapter 4 exercises in this presentation. So if the presumption is that you've listened to the chapter 4 lecture, if you have not yet done that, I would suggest you go back and do that first and then come back to this one. Okay class, so in this first problem they want us to solve for revenue, expense, and income numbers in each of the following examples, A through E. And so if we start with letter A and we know our cost of goods sold is equal to beginning inventory plus purchases. We'll just use P less ending inventory. And so if we fill in our pieces, we have $8,000 here, $38,000 here. Ending inventory is what we're solving for. And they tell us the cost of goods sold is $34,050. So if we take $34,050 minus 8,000 minus 38,000, this is 11,950. Okay. And then we know that sales less cost of goods sold equals gross profit. So we have 62,000 less 34,050 equals gross profit of 27,950 less 10,000 of expense is 17,950 net income. Okay. So in letter B, we know that I shouldn't erase that formula. Let me put it back. We know that our cost of goods sold is equal to beginning inventory plus purchases less ending inventory, right? So if we fill in our pieces parts, our beginning inventory is 17,050. Our purchases, we don't know. Our ending inventory is 3,000. And our cost of goods sold is 16,000. So if we say 16,000 is equal to, gosh, I can't get an equal sign in there, is equal to 17,050 plus question mark, right? Minus 3,000. So if we subtract 17,050 and we add 3,000 to both sides, this less 17,050 makes it 0. This plus another 3,000 is a net of 0, right? Negative 3 plus 3 is 0. So we're left with 16,000 less 17,050 plus 3,000 is going to be equal to our x or our question mark that we're trying to solve for. So if we take $16,000 less 17,050 plus 3,000, that should mean our purchases are 1,950. Okay, and if we know that our purchases are 1,950, or I'm sorry, if we know our sales are 43,500, and we know that our cost of goods sold is 16,000, 43,500 minus 16,000 is 27,500 less 10,650 gets us to our net income of 16,850, right? Okay, so then I accidentally gave us the ending answer there of 42,250, but here's how we solve for that one. So we had 46,000 less some number for cost of goods sold equals 3,750. So if you know your sales are 46,000 and you know that your gross profit is 3,750, you can back into the 42,250 cost of goods sold, okay? Because we know that sales less cost of goods sold equals gross profit. And then if we want to, now that we know what cost of goods sold is, we can solve for purchases. So we just solved for cost of goods sold for 42,250 equals beginning inventory of 7,500 plus X, we don't know what purchases are, less $9,000, right? So if we subtract 7,500 from both sides, that makes us go to 0. And if we add 9,000 to both sides, that makes that go to 0, right? So subtract that plus 9. Then we know that x is 42,250 minus 7,500 plus $9,000 is 43,750. Okay. All right, so then in letter D, we've got, we don't know what our sales are, but we do know that our, I gave you the cost of goods sold number as well, but really they give you all the pieces of it. I got click happy here and hit my mouse too many times. So, okay, the merchandise inventory is 8,000 plus the total purchases is 32. Less ending inventory of 6,600 is how we get to that 33,400. So if we know that our gross profit is 45,600, our cost of goods sold is 33,400. We know that sales, let me erase this formula too, so I have enough room. Hold on. All right, so we know that our sales less our cost of goods sold equals gross profit. And we just solved for cost of goods sold of 33,400, right? And they gave us gross profit of 45,600. And so we're solving for X. So if you add 33,400 to both sides, that's how you get to your sales, right? 33,400. So 45,600 plus 33,400 means our sales must be 79,000. And then in the last one, letter E, we're solving for ending inventory, which is the same as the first one, gross profit and net income. So we said that our formula is cost of goods sold equal to beginning inventory plus purchases less ending inventory. Okay. So let's see, they tell us that our cost of goods sold is 7,000. They tell us that our beginning inventory is 4,560. Our purchases are 6,600. So we're solving, excuse me, for X. So if we subtract 4,560 from both sides, and we subtract 6,600 from both sides, oops, I don't want to put that there, put that here. That makes that 0, that makes that 0. So we have X is equal to 7,000 less 4,560 less 6,600 equals 4,160 negative. Okay, and so we know that our sales are 25,600 less $7,000 of gross profit, or I'm sorry, $7,000 of cost of goods sold equals $18,600 of gross profit less $6,000 of expenses is $12,600. Okay, so same problem, different numbers. Why don't you pause the recording? When you've finished or you get stuck, resume the recording and we can go through the answers. Okay, so very similar to the first one. If in letter A we solve for ending inventory, we have cost of goods sold equal to beginning inventory plus purchases less ending inventory. Cost of goods sold is 45,000. Beginning inventory is 4,000. Purchases are 47,000 minus X, right? So if you add 4,000, or if you subtract 4,000 and 47,000 from both sides, you end up with X equal to $6,000. $57,000 of sales less cost of goods sold of 45 is gross profit of 12. Less 4 is net income of 8. And letter B, we have cost of goods sold of 14,000 equals beginning inventory of 2,000 plus purchases of X minus 3,000 of ending inventory. You subtract 2 and add 3 to both sides. You'll solve for X. 14,000 minus 2,000 plus 3,000 is 15. We have 65,000 of sales less cost of goods sold of 14. It's gross profit of 51. Then letter C, we have beginning inventory of 8,000 less purchase or plus purchases of we don't know minus ending inventory of 9,000. And they're asking us to solve for cost of goods sold. Well, here's the problem. We have two X's, right? So we can do it one of two ways. We can either go algebra on it, or if we know that net income of negative 6,500 or net loss, less expenses of 12, we could back into gross profit, and we could take sales less cost of or less gross profit to get cost of goods sold. Or I think we can do it this way with the algebra problem. So we could take, we subtract X. Oh no, we can't. I'm not that smart. So let's not do it that way. That's too hard. Okay, so we know that, let me erase this formula. All right, so we know that gross profit minus expenses equals net income or net loss. And so gross profits are X, our expenses are 12, and we know that our net loss is 6,500. So if we add $12,000 to both sides, that takes us to 0. So then you have X equal to 6,500 less, or negative 6,500 plus 12,000, or 12,000 minus 6,500, right? So we know that $5,500 is our gross profit number, which that should be there. It's not yellow, so I'm not sure what's going on there. But so if we know that our gross profit is 5,500, and we know that our sales is 51,000, then that must mean our cost of goods sold is 45,000. So let's go here and let's put our cost of goods sold formula back in. So cost of goods sold is 45,500. Cost of goods sold equals beginning inventory plus purchases less ending inventory. So we know that's 45,500. We know our purchases is our beginning inventory is 8,000. Our purchases is X. Our ending inventory is 9,000. And so if you add 9,000 to both sides and you subtract 8,000, that makes that 0. That makes that 0. We're left with X equal to 45,500 plus 9,000 minus 8,000 equals 46,500. Or 45,500, sorry. Oh no, 46,000, that's right, sorry. 46,500. This is the 45,500 for cost of goods sold that we solved for using our 5,500 gross profit. Okay. Then in letter D, okay, in letter D, we don't know what sales are, but we do know what gross profit is. We do know what expenses are, and we do know what net income is. So they give us all the pieces parts of cost of goods sold. So all we got to do is add those up. So we have $12,000 plus $45,000 less $8,000 equals $49,000 cost of goods sold. And we know that sales less cost of goods sold equals gross profit. Gross profit is 27,000. Cost of goods sold is 49,000. So sales must be, we add 49,000 to both sides, then we have X equals 27,000 plus 49. So $76,000. And then in letter E, finally, we have our cost of goods sold formula again here. Cost of goods sold equals beginning inventory plus purchases less ending inventory. So we've got beginning inventory of, well, they tell us cost of goods sold, so 26,000 equals beginning inventory of 6,800 plus purchases of 23,700 minus X. So if you subtract 6,800 from both sides and you subtract 23,700 from both sides, that goes to 0, that goes to 0. You're left with 26,000 less 68,000 less 23,700 equals negative X, right? Or equals X, I guess. So 26,000 less 6,800 less 23,700, X is equal to 4,500, negative. And then if we know our sales are 48,000 less our cost of goods sold of 26,000, means our gross profit is 22,500 less 8,000 of expenses, 14,500. So hopefully you did well on those. Okay, so in this problem, they want us to record purchases, returns, and allowances. So we're to prepare the journal entries to record the following transactions for the retail store recycled fashion. They use a perpetual inventory system and the gross method. If you remember from the lecture, the gross method means they originally record the inventory at the cost of, not including the purchase discount that's available. And then if they end up paying it in time, they take that discount and they adjust the inventory account. Okay. All right, so on April 2nd, the company purchased $4,600 of merchandise from Lion Company. Credit terms $215, net $60. Invoice dated April 2nd. And FOB shipping point. So FOB shipping point, the ownership rights or the transportation costs transfer at the time it hits the truck to be shipped, and they become part of the buyer's responsibility. The buyer records those as part of inventory cost. Okay. So we're purchasing merchandise. Merchandise inventory is an asset account. To increase that, we debit $4,600. Then we credit accounts payable to Lion for $4,600. Post those accounts or post that journal entry to the T accounts. Debits go to the left side, credits go to the right side. Then on the third transaction, the transaction that took place on April 3rd, rather, they paid $300 for the shipping charges on the April 2nd purchase. Well, when they do that, it just becomes part of their merchandise inventory, FOB shipping point, right? So they have a debit for $300 to merchandise inventory. They have a credit to cash. Post those to our T accounts. Okay. Then in the next transaction, they returned unacceptable merchandise that had an invoice price of $600. So we're going to reduce our accounts payable because we haven't paid them yet with a debit of $600, and we're going to reduce our inventory, debit of $600. Post those to our T accounts. Right? Then in the next transaction, they sent a check to Lion Company for the April 2nd purchase, net of the discount and the returned merchandise. So they bought the merchandise on April 2nd. They paid it on April 17th. There was a 2%, I think it was 2% discount if they paid it within 15 days. And so when we pay them, let's see, we've got net of the discount. So we have merchandise inventory, or I'm sorry, we have accounts payable of $4,600 less the $600. So we have accounts payable of $4,000. So we're going to reduce our accounts payable by $4,000. We're going to reduce our merchandise inventory by the $80, which is 2% times 4,000. That's the discount. When we take the discount, we just reduce the cost of our inventory, and inventory is reduced with credits. And then we're going to have cash out the door of $3,920 because we're only paying 98% of our payable balance of $4,000 because we took the discount. Okay. Post those to our T accounts. Then in the next transaction, we purchased $8,500 of merchandise from Frisk Corp, with credit terms of 110 net 30, an invoice dated April 18th, shipped FOB destination. So we as the buyer are not responsible for the shipping costs because they don't become our property until they reach the destination. So we're going to record merchandise inventory of $8,500. We're going to record an accounts payable to Frisk of $8,500. Post those to our T accounts. Okay, so after negotiations, we received from Frisk a $500 allowance towards our $8,500 purchase. So we're just going to reduce our accounts payable by $500. We do that with debits. And we're going to reduce our inventory by $500. Post those to our T accounts. Then on the next transaction, we sent a check to Frisk for paying for the April 18th purchase, net of the discount and the allowance. So I believe we had a 1% discount from a couple slides ago if we paid within 10 days, I believe. And so we're going to reduce our accounts payable to Frisk. So we have a balance of $8,000. So we're going to reduce our balance to zero by putting a debit to our accounts payable account for $8,000. But we're only going to pay them $8,000 less. Would that be $80 as 1%? So our cash discount or our reduction to inventory is $80. And the cash that's going to go out the door is $7,920. That is 99% of the $8,000 we owe them because we got to take a 10% discount. Discounts just reduce the cost of our inventory. Right? We originally bought it for $8,000, but then we paid our invoice sooner, and so we got a discount. So actually the inventory only cost us $7,920. Okay. Post that to the T accounts. We have an ending balance of $12,140 in our merchandise inventory. That's taking all of our debits less all of our credits, right? We have an ending balance in our cash account of $12,140. That's assuming that we started at zero. And then we have zero balances in both of our accounts payable accounts because what we've recorded has now been paid. Okay, same exact problem, different numbers. Why don't you pause the recording, take a few minutes, see if you can't get through all of these yourself, and then resume the recording and we can go through the answers. All right, so on April 2nd, we purchased $5,400 of merchandise inventory from Lyons Company with credit terms $215 net 60, 2% discount if paid within 15 days. If not, you owe the balance in 60 days. Invoice was dated April 2nd, and it was shipped FOB shipping point, meaning the shipping costs are our responsibility. So our first journal entry, debit merchandise inventory, credit accounts payable. Post those to the T accounts. Debits get posted to the left side, credits get posted to the right side. In our second transaction, we paid $500 for shipping charges on the April 2nd purchase. They were shipped FOB shipping point, meaning they become the buyer's responsibility at the time they hit the truck for transportation to the buyer's facilities. So we increase our merchandise inventory cost by the $500. And they don't tell us how we paid, so we're assuming cash. Credit $500. Post those to our T accounts. In the third transaction, Lion Company returned unacceptable merchandise that had an invoice price of $800. So when we return goods, we reduce our inventory and we'll reduce the amount that we owe the vendor, right? So we reduce accounts payables with debits. So we're going to reduce accounts payable to Lion by $800 debit. And we're going to reduce our merchandise inventory by $800 credit. Post both of those to the T accounts. Debits to the left side, credits to the right side. Then we sent a check to Lion Company for the April 2nd purchase, net of the discount and the returned merchandise. So our accounts payable balance is $5,400 less 8. So to take that to zero, we need a debit of $4,600. So we're going to debit accounts payable $4,600. We're going to reduce our merchandise inventory by the discount that we took. So 15% of $4,600 is $92. And then the cash out the door is going to be $4,508. Post all those to the T accounts. Credits to the right side, debits to the left side. Then in the next transaction, we purchased $7,000 of merchandise from Frist Corp with credit terms 110 net 30, so 1% discount if you pay within 10 days. Pay the net if you pay within 30. The invoice is dated April 18th and it's shipped FOB destination, so we are not responsible for shipping costs. They do not become ours until they reach our destination as the purchaser. So we're going to record a debit to merchandise inventory to increase it for $7,000. We're going to credit accounts payable for Frist, $7,000. Post those to our T accounts. Create a new T account here for Frist. Post our credit to the right side. Then after negotiations, we received a $1,200 allowance from the April 18th purchase. So we're going to reduce our accounts payable by $1,200. We do that with debits. We're going to reduce our inventory, $1,200. Okay. Post those to our T accounts. Post our accounts payable to the left side, our inventory to the right side. And then we're going to pay them on April 28th for the April 18th purchase, net of the discount and the allowance. So we paid them within 10 days, so we get to take our discount. So we're going to reduce our accounts payable. Our balance is $5,800. So in order to make that go to zero, we need a debit to accounts payable for $5,800. Our discount is going to reduce our inventory cost, right? So 1% of $5,800 is $58. So we're going to reduce our merchandise inventory by $58 with credit. And the cash that we're going to send out the door is $5,742. And that is 99% of our accounts payable balance because we took a 1% discount. All right, so hopefully you did well on that one. Post all those to our T accounts. Computer balances. And we're done. Okay, so in exercise 4.4, we're going to record those sales returns on allowances for Macy Company. So Allied Merchandisers was organized on May 1st. Macy Company is a major customer/buyer of Allied, who's the seller. And we're going to be asked to prepare the journal entries for the following transactions for Allied. So we're producing the journal entries for the seller side, assuming they have a perpetual inventory system in the gross method, meaning that they estimate returns using an adjusting entry at year end. And then here's all of our transactions. They'll be each of them on the subsequent slides. All right, so on May 3rd, Allied made its first and only purchase of inventory for the period on May 3rd, 2,000 units at a price of $10 cash per unit for a total cost of 20. We don't even have to do the math, right? So on May 3rd, what do we record? Increased inventory, right? 2,000 units times $10 per, $20,000 debit, increase inventory asset account with a debit, reduce cash. Then on May 5th, they sold 1,500 units of inventory at $14 per unit. And we don't even have to do the math there either. They tell us the invoice total was $21,000 to Macy Company under credit terms 210 net 30, and the goods cost Allied $15,000. So here's where you gotta pay attention. So our invoice total was $21,000. That's going to be our revenue, right? But we have a two-step process. If you remember from the chapter 4 lecture, we have to record our revenue, our sale piece of the transaction, and then we also have to record our cost piece of the transaction, right? So our sale is $21,000 of goods that originally cost us $15,000. So we're going to record our sale first, accounts receivable, increase that by the $21,000. And then we record our sales, increase sales, it's a revenue account. Revenue accounts are increased with credits, $21,000. And then we have to record our cost. So we're going to record our cost of goods sold, which is an expense account. We increase that with a debit of $15,000. And then we reduce our inventory for the goods that we've sold that are no longer in our inventory, right, of $15,000. Then on May 7th, Macy returns 125 units because they didn't fit the needs that they had. So Macy is the customer. They purchased from us. Now they're saying, yeah, seller, I don't want these goods. And so we have to put those goods back in inventory. And we also have to reduce our revenue, right? So the invoice amount, the sale price was $1,750. That's what we have to reduce our revenue by. But the cost of those goods was $1,250. So we have to restore those units, the cost of those units, to our inventory account. So on the 7th, we're going to record a sales returns and allowances. Okay, that's a contra revenue account. So it works kind of like, well, if you remember, our accumulated depreciation was a contra asset account. So in revenue, we have contra accounts too, and this is an example of a contra account for revenue. So revenue normally increases with a credit. The contra revenue account would increase with a debit. So we're going to record our sales returns and allowances for the invoice cost that's being returned, $1,750, and we're going to reduce our accounts receivable that customer owes us by $1,750. Then we need to restore the goods to inventory because there's nothing wrong with them. They just didn't need them, right? So we're going to debit inventory for the $1,250. And we're going to credit cost of goods sold for $1,250. Then on May 8th, Macy discovers that 200 units are scuffed, but they're still of use, and so they want to keep them, but they want a credit. They don't want to pay as much for those units. So we, seller, Allied, are going to send Macy a credit memorandum for $300 towards the original amount to compensate them for the damage. So when we do that, we record sales returns and allowances, contra revenue account increased by $300 with a debit, works the opposite of revenue accounts. And then we're going to reduce their receivable balance by $300. Then on the 15th, Allied receives payment from Macy, so we receive payment from Macy for the amount owed on the May 5th purchase that's net of the returns, allowances, and any cash discount. So I think they paid within the discount period, so we're going to give them that discount. And we've got the original $21,000 less the $1,750 less the $300. So Macy's got accounts receivable, 21 less $1,750 less $300 of $18,950. That's the balance in their accounts receivable from Macy. We're going to take that to zero. We reduce receivable accounts with credits. The sales discount is going to be for, I think, 2%, but I can't remember what the previous slide said. Yes. So 2% times $18,950. We're going to record sales discounts of $379. That's a contra revenue account as well, increase with debits. And then the net is going to be the cash that we received, which is 98% of the accounts payable balance. All right, so this is the same problem, different numbers. Why don't you give a try and resume the recording when you're finished, and we'll go through it. Okay, so on May 3rd, Allied made its first and only purchase of inventory for the period on May 3rd, 3,000 units at a price of $12 per. So total cost of $36,000, debit inventory, credit cash. Then on May 5th, they sold 1,400 units of inventory at 20 per unit. Invoice totals $28,000, so that's our revenue side. But the cost part of our transaction is $16,800. So we're going to record a debit to accounts receivable and a credit to revenue for the $28,000 sale price. And we are going to record cost of goods sold and reduce our inventory by $16,800, which is the cost of the goods that they sold to Macy Company. Then on May 7th, when Macy returns 200 units, we're going to debit our contra revenue account, sales returns and allowances, for the $4,000 that we sold to them that they said don't fit their needs. But they're not damaged, they're still usable, so we're going to put them back in inventory. So here's the first part of our transaction is to record the sale return and allowance and reduce the receivable that they owe us. Then the second part is to put those goods back in inventory and reduce our cost of goods sold, right? So to put them back in inventory, we debit, and to reduce our cost of goods sold, we credit. Then on May 8th, Macy discovers that 200 units are scuffed but still of use, so they're going to keep them, but they want a credit memorandum. And so we're going to debit sales returns and allowances for the credit that we gave them, and we're going to reduce their account receivable balance by $800. Then on the 15th, they received payment from Macy for the amount owed on the May 5th purchase, and it's net of any returns and allowances. So again, we had a $28,000 AR balance that we started with. Then they returned some goods for $4,000, and we gave them a credit memorandum for $800. So we're going to reduce our accounts receivable balance for the net of all of those. So that's $23,200. We're going to record sales discounts for 2% of that $23,200, which is $464. And then we're going to debit cash for 98% of the accounts receivable balance because they took a 2% discount. Okay, hopefully you did well on that one. All right, so now recording entries, purchaser and seller. So in exercise 4.6, Santa Fe Retailing is purchase merchandise as is, with no returns from Mesa wholesalers, with credit terms of 3% if paid in 10 days or owe the net in 60, and an invoice price of $24,000. Merchandise had a cost to Mesa of $16,000. Assume that both the buyer and seller use a perpetual inventory system in the gross method, meaning that they record the cost or the sale at the gross, and then if they take the discount as the purchaser, or if they give the discount because the buyer or the customer paid within the discount period, they record the discount and the effect of the discount at that time. So prepare the entries that the buyer records for the purchase and the cash payment within the discount period, and then what if they paid the cash after the discount period? And then prepare the entries that the seller records, okay? So first, let's prepare the entries that the buyer records. So in this case, we're Santa Fe Retailing, we're the buyer. So we purchase goods from Mesa at $24,000. So our purchase is going to be a debit to inventory, right? And a credit to accounts payable for $24,000. Purchase the merchandise on credit terms 310 net $60. Then if we pay them within the 10 days, we're going to reduce our accounts payable by $24,000. We are going to reduce the cost of our merchandise by the discount that we're going to take. So that's $24,000 times 3%, or $720. We reduce our merchandise inventory with credits, and then we're going to pay them cash for the 97% of the original invoice price, because we took the discount, $23,280. If we don't take the discount, we're just going to reduce our accounts payable, $24,000, and we're going to reduce our cash by $24,000. Okay? So if you're the purchaser, there's only one side. You don't have to do anything with cost. You just record the purchase in your inventory, right? But, okay, this time we're the Mesa wholesaler. We're the seller, not the purchaser. So we're going to prepare the entries that the seller records for the sale, for the cash collection within the discount period, and then the cash collection after the discount period. So when Mesa sells goods to Santa Fe, they sell them at a price of $24,000, but they have a cost of $16,000. So when you're the seller, you have to record both the revenue and the reduction to your inventory, right? So when we sell it, we record an accounts receivable increase debit $24,000, and we record an increase to sales for $24,000 as well. Then we have to record the cost of that sale. So we're going to increase our cost of goods sold by $16,000, and we're going to increase our merchandise inventory by $16,000. Then if we pay within 10, or if the customer pays us within 10 days, we're going to record a contra revenue account, sales discounts. Oh, they got this backwards. So accounts receivable, so that's 24,000. Oops, wrong one. 24,000. So we're going to reduce our accounts receivable by 24. We're going to record a sales discount, which is a contra revenue account, for the 24,000 times 3%, $720. We increase contra revenue accounts with debits. And then we're going to record the sale that we received from Santa Fe for $24,000 times 97% because they paid us within the discount period. Okay, $23,280. If they pay us after the discount period, we just record our cash increase of 24 and we reduce our accounts receivable with a credit of 24. Okay? Okay, you know the drill. Why don't you pause the recording, take a stab at this problem, and then when you are finished or you are stuck, resume the recording and we can go through the answers. Okay, Santa Fe Retailing purchased merchandise as is with no returns from Mesa Wholesaler with the credit terms $310 net $60, invoice price of $40. So in this case, we're the buyer. We are the buyer. So we are Santa Fe Retailing, right? So when we purchase the goods, the only thing we need out of this problem is this $40,000. So we're going to record merchandise inventory increase of $40,000, and we're going to record an increase to accounts payable for $40,000. Then if we pay within the discount period, we're going to reduce our accounts payable by 40 with a debit. We're going to reduce the cost of our inventory by 3% of that 40 because we took the discount. So our merchandise inventory now costs us $1,200 less than it did. We're going to record cash for the 97%, $38,800. If we do not pay within the discount period, we just reduce our accounts payable, debit of 40, and reduce our cash with a credit of 40. Okay, so in this case, we are the wholesaler now. We're the seller, right? So we care about both the revenue and the cost. So when we record the sale, we have to record two transactions or two separate journal entries, right? So to record the sale, we're going to record the accounts receivable increase with a debit of 40, and we're going to record revenue increase with a credit of 40. Then we also have to record our cost So we're going to record our cost of goods, which they tell us is $22,000, increase cost of goods sold with a debit of $22,000, and we're going to decrease our inventory with a credit of $22,000. Then if we pay within 10 days, or if the customer pays us, within 10 days, we're going to give them a discount, right? So our accounts receivable is $40,000. We're going to reduce that. We reduce accounts receivables with credits. We're going to record a sales discount, which is a contra revenue account increased by debits for the 3% discount we're going to give them, $1,200, and then we're going to collect cash for the other 97%. If they don't pay us within the discount period, we just record cash of $40, and we reduce our receivable for $40. Okay, hopefully you did well on that one. Let's move on to the next. All right, so inventory and cost of sales T accounts. So the following supplementary records summarize Tesla Company's merchandising activities for 2017. Set up T accounts for merchandise inventory and cost of goods sold, and then record the summarized activities in those T accounts and compute the balances. Okay, so let's record each of the transactions in the T accounts. So cost of merchandise sold to customers and sales transactions. So when we sell our merchandise, we debit cost of goods sold and credit merchandise inventory, right? So we post our credit to the right side of the merchandise inventory account for $196. We post our debit to the left side of the cost of goods sold account. Merchandise inventory, December 31st of 2016. We start with $25,000, so that goes to the left side of our merchandise inventory account. The invoice cost of merchandise purchases, so increase to merchandise inventory or a debit or the left side of the T account for $192,500. The shrinkage determined on December 31st, 17, $800. We're going to reduce merchandise inventory with a credit of $800 on the left side. Cost of transportation in, shrinkage, the other side goes to cost of goods sold. Then cost of transportation in, $2,900. That increases our merchandise inventory, so it goes to the left side. Cost of merchandise returned by customers and restored to inventory. So we're going to increase inventory for returns, and we're going to decrease cost of goods sold for returns. Purchase discounts received for the $1,700 goes to the credit side of our merchandise inventory account. Purchase returns and allowances goes also to the right side of our T account for merchandise inventory for $4,000. That doesn't affect cost of goods sold, so we don't have to do anything there. So then if we take our debits less our credits, we have a balance in merchandise inventory of $20,000. We have a balance in cost of goods sold of $194,700. Right, so you know the drill. Pause the recording. Record all of these transactions to the T accounts for merchandise inventory and cost of goods sold to the extent that they apply and are applicable to those accounts. And then when you're finished, resume the recording and we can go through the answers. All right, cost of merchandise sold to customers. So debit to cost of goods sold and a credit to merchandise inventory. Merchandise inventory beginning balance is $28,000. That's a debit side transaction. Cost of invoice cost of merchandise purchases. It's the debit side as well. Other side would be cash or AP or something like that. Then shrinkage reduces our cost of goods or increases our cost of goods sold and reduces our inventory. Cost of transportation in increases our inventory. Cost of merchandise returned by customers increases our inventory and decreases our cost of goods sold. Purchase discounts received decreases our merchandise inventory. Purchase returns and allowances also decreases our merchandise inventory, but neither one of those affect cost of goods sold. So then we have a balance of $26,100 in our merchandise inventory, debits less credits. Cost of goods sold, balance is $205,200. debit. Okay, so in this slide, we're being asked to prepare the journal entries for the merchandising transactions of Dollar Store, assuming it uses a perpetual inventory system and the gross method. So on November 1st, Dollar Store purchased merchandise for $1,500 on 2/5 net 30, so 2% discount in 5 days, net in 30. FOB shipping point, so it becomes the responsibility of Dollar Store at the time that it hits the truck to be shipped to Dollar Store. The invoice is dated November 1st. So on November 1st, we record merchandise inventory for $1,500 and accounts payable for $1,500. Then on the 5th, Dollar Store pays cash for the November 1st purchase. So they paid within the 5 days, so they get a 2% discount. So we're going to reduce our accounts payable by $1,500. We're going to reduce our inventory by the discount, just because our cost of our inventory is going to go down a little bit because we took advantage of the discount. So that's $1,500 times 2%, or $30. And then we're going to pay cash of $1,470. Then on the 7th, Dollar Store discovers and returns $200 of defective merchandise purchased for a cash refund. So on November 7th, they're going to get cash of $200 times 98% because they took the discount. So they didn't pay full $200. They only paid 98% of that. So $196. And then we're going to reduce merchandise inventory by $196. Then on the 10th, Dollar Store pays $90 cash for transportation costs from the November 1st purchase. So FOB shipping point, the buyer is responsible for the goods and the cost of transporting those goods to their location. And so that just becomes part of merchandise inventory costs. So that's an increase of inventory at $90 and a reduction of cash for $90. Then on the 13th, Dollar Store sells the merchandise for $1,600 with terms net 30. The cost of that merchandise was $800. So we're going to record our accounts receivable for that $1,600 sale and an increase to revenue for $1,600. Then we're going to increase our cost of goods sold with a debit of $800. And we're going to reflect a reduction in merchandise inventory for the goods that we've sold with a credit of $800. And then on the 16th, the merchandise is returned to the Dollar Store from November 13th transaction. Returned items are priced at $160 and cost $80. They were not damaged, so they were returned to inventory. So we need to record our sales returns and allowances, which is a contra revenue account. We increase contra revenue accounts with debits for $160. That's the cost, or the sale price, rather, of the goods. And then we're going to reduce our accounts receivable with a credit of $160. And then we have to return the goods to inventory and reduce our cost of goods sold. So we're going to increase inventory by $80 for the goods that were put back into inventory. And we're going to reduce our cost of goods sold by $80. All right, same problem. Why don't you pause the recording, try it out, and then you can resume the recording and we'll go through the answers. All right, so on November 1st, Dollar Store purchased merchandise for $2,000 on terms 2/5 net 30. FOB shipping point, invoices dated November 1st. So on November 1st, they're going to increase their merchandise inventory, and they're going to do that with a debit. And they're going to increase their accounts payable with the credit. Then they're going to pay for the goods on November 5th, so they get to take advantage of the discount. So we're going to record an accounts payable decrease for the whole $2,000. We're going to reduce our merchandise inventory for the discount that they've taken, $2,000 times 2% or $40. And then we're going to pay them cash of $1,960. Then on November 7th, the Dollar Store is going to discover and return $300 of defective merchandise for a cash refund. Well, so they've already paid for the goods. So the cash refund that they're owed is 98% of the $300 worth of defective merchandise. So they're going to get cash at $294, and we're going to decrease our inventory by $294. Then on the 10th, the Dollar Store is going to pay $240 cash for transportation costs. Transportation costs, when they're FOB shipping point, are the responsibility of the buyer, and they just increase the cost of the inventory. So we're going to increase inventory by $240, and we're going to decrease cash with a credit of $240. All right, then on the 13th, they sell merchandise for $2,160, terms net 30. The cost of that merchandise is $1,080. So we're going to record an accounts receivable for $2,160 debit. We're going to increase our sales with a credit of $2,160. Then we also need to recognize the cost piece of our sale. So we're going to increase cost of goods sold for the cost of the goods they sold, which they tell us is $1,080. And we're going to decrease merchandise inventory for the items we no longer have because we've sold them. Credit of $1,080. Then on the 16th, merchandise is returned to the dollar store from the November 13th transaction. The returned items are priced at $230 and they cost $115. They weren't damaged and they were returned to inventory. So we need to record our sales, returns, and allowances for $230. It's a contra revenue account increased with a debit. And then we're going to record an accounts receivable decrease for the items that were returned that will no longer be owed to us. So that's $230 credit. And then we need to record the cost, or restore those items to inventory and reduce our cost rather for the items that were returned. So we're going to increase our merchandise inventory for the cost of $115, and we're going to reduce our cost of goods sold with a credit of $115. All right, so in this entry, or this problem, they want us to record the adjusting and closing entries for the merchandiser. So the following is a list of the selected permanent accounts and all the temporary accounts for December 31st of 2017, unadjusted trial balance of Amico Company. So Amico Company uses a perpetual inventory system, and they want us to close or use the account balances along with the additional information to journalize the adjusting entries and the closing entries. All right, so there's our unadjusted trial balance. And they tell us that we have accrued sales salaries of $1,700. We have prepaid selling expenses of $3,000 that have expired. And a physical count of the year-end merchandise inventory shows 28,700 of goods still available. So our adjusting entries, we need to accrue our salaries. So we're going to record sales salaries expense with a debit of $1,700 and accrued salaries or salaries payable with a credit of $1,700. Prepaid selling expenses that have expired are $3,000, so we need to record selling expenses of $3,000, debit, and then we need to reduce our prepaid selling expense asset account by $3,000, and we do that with a credit. And then the physical count shows that $28,700 are still available in our merchandise inventory account, and so we have $30,000 on our unadjusted trial balance. We need to be at $28,700, and so to reduce our inventory account, we'll credit or debit our cost of goods sold by $1,300, and we'll credit our merchandise inventory by $1,300. So then we post our adjustments to our middle column there. So we'll post our salary expense debit, post our debit to selling expense of $3,000, post our credit to merchandise or our credit to prepaid selling expenses for $3,000, our debit to cost of goods sold for $1,300, our credit to purchase inventory or merchandise inventory of $1,300, and then you add across, right? So we had a debit of $30,000. Our adjustment is a credit of $13,000, so the net of the two is a debit of $28,700. We had a debit of $5,600. We posted a credit of $3,000. What's remaining is $2,600. Dividends didn't change. Sales didn't change. Returns and allowances, sales discounts, neither one of those changed. Cost of goods sold had a debit of $212 plus a debit of $1,300. Now we have $213,300. Salaries expense $48,000 plus another $1,700. Utilities didn't change. Selling expenses $36,000 plus $3,000, $39,000. administrative expenses didn't change. Then we post all of our closing entries, right? So merchandise inventory and prepaid selling expenses, those don't close. Those are balance sheet accounts, right? So dividends, or I guess they're starting with sales. So let's start with sales. So to close the sales account, we have a credit. We need a debit to take it to zero. The other side is income summary. And then our sales returns, allowances, sales discounts, cost of goods sold, all of our expenses are all debit balances. So in order to close those, we need credits. Sum up all your credits. That's a debit to income summary of $444,500. Close our dividend account. So we have a debit in dividends of $33,000. So, oh, I'm sorry, back up a minute. So then we close our income summary account of $84,500, which is the difference between the $529 and the $444,500. And the other side of that gets posted to retained earnings. Then you close your dividends into your retained earnings as well. So we need a credit to dividends and a debit to retained earnings. And then we're finished. All right, so same problem, different numbers. Why don't you take a stab at it and then resume the recording and we can go through the answers. All right, so accrued salaries amount to $2,500. So we're going to post sales salaries expense, debit of $25, sales salaries payable, credit of $2,500. Prepaid selling expenses of $4,500 have expired, so we're going to record selling expenses with a debit of $4,500, and we're going to reduce our prepaid selling expenses with a credit of $4,500. Physical count of inventory shows that there's $41,650 in the account. We started on our unadjusted trial balance of $4,300 or $43,000 rather. $43,000 less $41,650. We're going to debit cost of goods sold and we're going to credit inventory. All right, then we post all of our adjustments in the right columns and then add across. Okay. So 43,000 less a credit of 1,350 is 41,650. 6,500 less a credit of 4,500 is 2,000. Dividends doesn't change, sales doesn't change. Neither does sales returns and allowances or discounts. And then your adjustments in your cost of goods sold, salaries expense, and administrative expense, add across. And then carry the rest of them that didn't change across to your debit column. Then we close all of our temporary accounts to the income summary. So merchandise inventory and selling expenses are permanent accounts. We don't close those. So our sales has a credit balance of $612. We need to take it to zero. So we're going to debit $612 and we're going to credit income summary. And then we're going to debit our income summary and credit all of our expense accounts or our contra revenue. So here's all of our expense or contra revenue accounts. 20,000 plus 3 plus 216 plus 57 plus 12 plus 35 plus 104 means that we need a debit to our income summary of $448,350. And then we're going to close our income summary to our retained earnings. So our income summary has a credit balance of $612 less a debit balance of $448,350. So in order to close that, that's a net credit balance of $163,650. So we're going to debit that amount to take it to zero, and we're going to credit retained earnings. And then we're going to increase our or decrease our retained earnings by our dividends. So we had $35,000 of dividends. We're going to debit retained earnings and we're going to credit dividends. We started with the debit balance of 35. We want to take it to zero. So we need a credit of 35 to dividends, and our offsetting debit is retained earnings. Okay. All right, so net sales for a multi-step income statement. So a company records or reports the following sales-related transactions. Gross sales of 200,000, discounts of 4, sales returns and allowances of 16, and sales salary expenses of 10. So if we prepare the net sales portion of the company's multi-step income statement, here's what it looks like. So you start with your sales, your discounts and your returns and allowances are contra accounts, right? So less 20 is net sales of 180. Salaries doesn't apply to the income portion, that's why it's excluded. So why don't you take a minute and prepare the multi-step income statement for the same company, but with some different numbers. And then when you're finished, resume the recording and we'll go through the answer. All right, so start with sales, 119. Our contra revenue accounts, sales discounts and returns and allowances, 3,300, 9,600. So we have gross sales of 119 less the discounts and returns and allowances of 12,900 for net sales of 106, 100. All right, so acid test and current ratios. So compute the current ratio and the acid test ratio for each of the following separate cases. And then which company is in the best position to meet short-term obligations. All right, so we said that the current ratio is current assets divided by current liabilities. So current assets divided by current liabilities for Camaro Company. Current assets are cash, short-term investments, current receivables, prepaid and inventory, so a total of $5,200. Here's your line right here. Divided by current liabilities of $2,200. It's a current ratio of 2.36. GTO is 3,500 divided by 12 for a current ratio of 2.92. And Torino is 7,300 divided by 3,750 for a current ratio of 1.95. So in this case, which company is in the best position to meet short-term obligations? The current ratio tells you how many assets they have for each, how many current assets they have for each dollar in current liabilities. So GTO is going to be in the best position, right? And then for the acid test ratio, it's total quick assets divided by current liabilities. And so quick assets are cash, short-term investments, and current receivables. So you just bring those numbers down, 2,000, 0, and 350. So Camaro has total current or quick assets, sorry, of 2,350. Total liabilities, current liabilities of 2,200. So they have an acid test ratio of 1.07. GTO has $110 of cash, 0 short-term investments, and $590 of current receivables. So they have quick assets of $700. Divided by current liabilities of $1,200 for an acid test ratio of 0.58. And then Torino has 1,600 and 700 for a total of $2,300 of quick assets, divided by 3,750 of current liabilities for a acid ratio of 0.61. So in this case, Camaro Company has the best acid test ratio. All right, so same thing here. Why don't you take a few minutes to complete the required question and then pause the recording and we'll go through the answers. Or unpause the recording. Okay, so again, current ratio is total current assets divided by current liabilities. So Camaro has a 2.69, GTO has a 1.95, and Torino has a 1.71. So in this case, Camaro is in the best position. And then the acid test ratio is quick assets. So it's the stuff that's readily convertible into cash. So cash itself, short-term investments, and current receivables. So pull all those down and add them up. Total quick assets for Camaro is 3,400 divided by 2,900. Acid test ratio of 1.17. GTO is an acid test ratio of 0.55. And Torino is an acid test ratio of 0.95. So in this case, Camaro is also in the best position. Okay? All right. All right, so preparing a multi-step income statement. So for Fit for Life Foods reports the following income statement accounts for the year ended December 31st. So they want us to categorize the following accounts as selling, which is wages, rent expense, selling space, TV ads, sales commissions, and then the rest are general and administrative. So on our income statement, we're going to start with sales, less our discounts and allowances for net sales of $200,000. Then we have our cost of goods sold of $90,000. I'm going to cross off the ones we've used here. Sales discounts, sales returns. Is that all in sales? All right. So we have our cost of goods sold of 90. So we have gross profit of 110. And then we have our expenses. So our selling expenses, they told us what those should be. So they told us that we should include rent expense, selling space, sales, staff of the wages, and there was one other, commissions, right? So sales, staff of the wages is 23,000. Selling rent expense, selling space for the rent expense for the selling space is 10,000. The TV ads are 2, and then sales commission of 13,000. So we have total selling expenses of 48,000. And then they said to classify everything else as general and administrative. So we'll have office supplies expense of 700, insurance of 1,300, depreciation of 5. Then we have office salaries of 32,500 for a total of 35,000. Total operating expenses of 83,000. So we have income from operations of 27,000. And then we have this other bucket, and that's where your gain and loss on sale of equipment comes into play, and then also your interest revenue. So we have our 62,500 or 6250, sorry, gain on sale of equipment, and interest revenue of 750. For total other revenues, gains, expenses, and losses of 7,000. For a total net income of 34,000. All right, so same thing here. Why don't you give it a shot, and then we'll see how you did. All right, so let's start with our sales. 219,000 less our discounts and our returns and allowances for net sales of 199,600. So we've used this one and we've used this one. And we've used our sales. Then we have our cost of goods sold of 91,900 for a gross profit of 107,700. Then we split up our expenses into selling and general and administrative. So our selling expenses, they told us, was sales staff wages, rent expense for selling space, TV ad expense, commission expense, for a total of 51,100. So we've used our sales for wages, our selling space, our TV ads, and our sales commission expense. Then we pull down all of our office expenses, or our general and administrative expenses rather. So that's office supplies, insurance, depreciation, and office salaries. So let's cross those guys off. For total general and administrative expenses of 34,260. And then we have total operating expenses of 85,360. So you have your gross profit less your selling expenses and general and administrative expenses. That gives you income from operations of 22,340. And then you have this other section, which is where you put your gain on sale of equipment and interest revenue. So we have gain on sale of $6,320. We have interest revenue of $760. So we're going to add to our income from operations of $22,340, this $7,080 for total net income of $29,420. Okay, so hopefully you did well on that. This is it for the Chapter 4 exercises. As always, if you have any questions or something doesn't make sense, feel free to reach out. Otherwise, best of luck on the homework. Thanks, guys. Take care.